So here we go.
Would you like me to start sharing and see if it works?
No, it's fine. I'm sure it will.
Okay.
I'm sure it
Okay.
will. I have
Okay.
every confidence, Narmin, that it'll work.
Thank you.
Morning,
Thank you.
Callum. Morning, Chris. Morning, Chris.
Morning.
Morning, Sapna. Morning, Catherine.
Hmm.
Hi, Con.
Good
Morning,
morning.
JQ. Hi, Peter. Podre, great to see you. Welcome, welcome, welcome. If you've just joined, if you could mute Callum and Chris, if you could do that, that'd be great. And morning, Christos. Thanks for joining. If you could mute as well. Great, excellent. Okay, let's just do that. Yeah, and Christos, if you could mute, that'd be great. And Bob, if you could mute, then we should yeah, cut out the background noise. Good. Okay. Right. Well, it's 10:32. Morning, everybody. Welcome to this week's Pension Playpen Coffee Morning. We are delighted to have Professor Narmin Nahidi here from the University of Exeter. I think it says that, but it's the wrong way around on my screen. So it may be the right way around on other people's screens, but there we go. Narmin, great to see you, great to meet you, and we really appreciate your presentation this morning. And they're a nice bunch. Obviously, I'm promising that they're a very nice bunch. So you know, I think we'll look after you, and you'll look after us, which should be great. So I'll monitor the lobby. If anybody wants to raise a hand during the session, please do. If anybody wants to put comments in the chat, please do. I know that Aaron and Sid have dialed in from Washington, so they're considerably earlier in the morning than we are. So I'm sure Aaron and Sid will interject as well at some point. We are recording as well. So is everybody happy? JQ, Callum, Chris, Bob, everybody's thumbs up. We're all recording. Okay, excellent. Well, I have set the scene, Narmin, Professor Nahidi. So over to you.
Thank you very much. Hi. Hi, everybody. Please call me Narmin. I mean, I really don't want to be called professor. And really nice to meet you all. I'm so grateful to meet you all. And honestly, no one really looks like retired or they need anything about retirement. So someone that needs to be retired would be me only. But anyway, I'm okay, I need to introduce myself properly, but let me share my screen first, so then it will be much more easier for me to just say everything using some visual tools, which I always do in my classes. Um, Please just let me know if you see the slides and if you see them correctly, like in the correct way of it. No, nothing else.
Yep, that's fine.
Yeah, wonderful.
Yep.
Okay, wonderful. So, as already Steve was so kind enough to introduce me, my name is Dr. Narmin Nahidi. I have a PhD in finance from Ca' Foscari University in Venice. I'm working in Exeter University, and I'm working especially with degree apprenticeship, which we are working with banks directly. We are teaching to banks. My research is on corporate finance, financial behavior, fintech, and neurofinance, which is a new stem of finance. And I'm very happy to work with, I'm delighted to work with Aaron and Sid on this project. I met Aaron last year in a conference, and immediately we became good friends. And now we are working together on different projects. What we are going to do is today we are going to share some of the results for the risk preferences survey that we created. I'm trying to explain the slides as simple as possible, and if that's okay with you, I'm gonna let Aaron or Sid reply your questions, so I have some backup if I need help. Aaron and Sid, just give me a thumbs up if you agree with that. But anyway, that will be what we were doing today, and I will try to finish this less than an hour. But if there's anyone who has any questions, you can write it on and type it on the team, or you can jump and ask. Because this presentation is based on a data, we see that the answers are honest, so it's like very straightforward. I will talk you through the framework, what were the global findings, and then I'm going to share with you what we are seeking on early UK data, which we are trying to get extensive data through the survey. And because it's very much a work in progress, still has not been published. So we genuinely want your inputs. If you can share it with any of your network, you can. You're exactly the kind of audience that can help us to share this research into something that is really useful for policy and also for practice. And I know that Aaron and Sid, they don't live in the UK, but I think they really like to contribute to our country. So we're really thankful for your kindness to our country, I would say in advance. Okay, so
You
today,
guys can be helped. We can't. That's why.
yes, yes, definitely, definitely. So why risk preference matters to the folks in the UK. So the outline why we should take this survey. So here's what I'm going to cover exactly. We start with a very quick 2 minutes prior on some behavioral finance, and I will do my best to make it so simple. I won't talk technical, I promise. It will be just enough to ground the discussion. Then I will look at the evidence saying about the risk preferences and what are the applications for DC pension design. Then we will share the results for our global survey and also our India study. And then we will go to what I suspect that you are mostly interested of, which is the early UK results. And I'm emphasizing on the word early because we hope that after this meeting, you guys can help us to have a better result. And yes, the question at the bottom is Aaron is being Aaron, I would say. We genuinely do not understand why do Brits and also women, they don't like this survey. We don't know that much. We have tried our best until now, and we ask from multiple banks, multiple companies, multiple students, anyone that we could to participate in the survey. But at this moment, we are not satisfied with the number, so we hope to have more. And again, if you have not taken the survey, this is the link that you can use to have this survey. I promise you it will take less than 5 minutes, and you will do us a big favor if you do that. So let's start by describing the world as it currently works. Modern pension design eventually rests in three pillars, as you see. And I love that Aaron, he designed the slides, and the way that this guy is trying to like pass from this pillar is wonderfully designed. Anyway, the first theory, we call it expected utility theory. This is where it's a pre-1970 assumption that people are perfectly rational and they're perfectly consistent and universally risk averse. So we know that is not really true, but it is still a foundation of a lot of actual models. And it's not just on risk, or it's not just in the behavioral finance. We will see the same thing in accounting. There are many accounting models that still they are existing, and right now many things are based on them, but everything is evolving, so these should be also. The second pillar that we designed here is the Kahneman and Tversky 1979 prospect theory. This is they were Nobel Prize winning, and they worked on this idea that showed that we actually are loss averse. So we overweight all small probabilities, and we are not consistent across gain or across any kind of losses. That was a genuinely breakthrough when we discuss about theories in risk. And the third one is the target date of, or we call it life cycle fund. This is when we implement of those insights into a policy in real time, in actual real time. And the logic is very simple. As you get older, you become more risk averse. I am one of those people, and I promise you, I don't look young. I'm older than what I look. So we automatically rotate individually into a safer assets. Honestly, as I'm saying, I'm thinking this morning I wanted to do one transaction, and I was not sure if this asset allocation is a correct one. Um, um, these kind of behaviors are something that some countries they mandate them. Like Hong Kong right now mandated this. The U.S. uses this as a safer harbor default, and they call it Pension Protection Act. I'm right, Aaron, yeah? And Ireland is another country. They made it law in January of this year about this rotation, that if you become older, you need to put your assets, whatever digital or physical, into a safer assets. The problem is that this is what actually this is what our research is about. That is that Kahneman and Tversky find these results from 67 American universities in 1979, and the entire global pension industry they had been I would say extrapolating from the sample ever since. And of course, we needed to update this. And they got it from students, university students. We wanted more than just the students. We wanted a bigger audience. So before I get to the data, I need to give you briefly about the three behavioral biases that are, I would say, most relevant to what we are doing, what we are going to discuss. The first one, I would say, is there are many, but these are, I would say, they are the most important one. The first one is the framing, the way a risk is described as a potential gain versus any kind of potential loss. This would change how different people, individuals, would respond to gain or loss. Um, you might ask why this is important. This matters a lot for pension communications. If you tell someone their fund is down 15%, they respond very differently than if you tell them that their fund is recovery toward to previous high. Like, again, depends, and of course it's a human nature. Whatever you tell any individuals, they might have a different reaction. But when it comes to money, I would say, when it comes to fund, the reaction is much more severe. The second example, or the second item, would be mental accounting, because in reality, people treat different pots of money differently. They might be very risk averse with their pension, which of course this is their lifetime saving, but perfectly they would be very happy to punt on individual stocks with separate ISA. It's another story when it comes to ISA, for example. So they're not rational distinction, but they're very real ones when it comes to what kind of an asset are we talking about. So I would say that each individuals they have different kind of mental accounting when it comes to type of the asset. And eventually we have regret avoidance. So this is where people make financial decisions that turns out very badly, especially if it is an unconditional one. They feel this would be more acutely than the ones that followed the crowd and lost at the same amount. This is one that it will be in each individual's mind. It will be the reasons fault default, sorry, I said fault, reasons default fund that is too sticky and nobody really wants to be blamed for that default that they think it will be. So I would say each one of us, and I'm sure I am like you guys, we had some decisions, financial decisions that we would regret, either if it is a small stock or if it is like a big investment or buying a house somewhere that you don't feel that there will be any good investment in 10 years. So that thing, this is called regret, and that decision is a default fund. So this one is the actual question from the original 1979 Kahneman Tversky survey. Questions? No. We wanted to show you because it shows exactly what are measuring. This is the question 3. The question 3, you can either take 3,000 pounds or 80% chance of winning 4,000 pounds. So the expected value of the option A is actually is higher than 3,200 pounds, but 80% of the people in that result, I'm sorry, I forgot to just do that. 80% of the people in that results, in that population, picked the sure thing. That's what we would call a risk aversion on gain. So again, as I'm saying, the idea was that either 3,000, pick a 3,000 or 80% chance of a 4,000. So again, it's a little bit dilemma. The question 4 was that it was the same kind of trade-off, but they scaled down to, instead of 80% here, they scaled down to 25%. So suddenly, as we see, 65% of the people took that gamble. So option A was, even though mathematically it is the same choice, that's people chose another option. That's inconsistency is what we called Elias paradox. This is what we say is the actual prospect theory that was built on this kind of examples. Our survey, what we do, we use 15 of this kind of pair questions. Some in it's about gain domain, some it's about loss. And the idea was that to build a complete picture of each one of us risk profile, we created these questions, not just one number, but we created a separate gain and loss scores. That separation turns out to be very important in our study, and we hope by you guys and the others who participating more, we would get more answers and we can analyze these two gain and loss scores separately. Then this is where I said that they will the choice was reversed. Here, let me bring everything so I won't forget what to say. This one is actually a larger stakes question pairs between question 13 and then we had a 13 prime. What we want you to notice is that it's a mirror image structure actually. Question 13 is a gain scenario, and question 13 prime is exact same question framed as a loss. So it's a kind of a tricky, but it's very clever. On the gain side, as you see, 82% of people, they prefer the sure thing, which will be the risk aversion. On the loss side, 70% of people, they prefer on uncertain option, which will be more risk seeking. The same mathematical structure for both of them, completely different behavior results depending on whether you who is participating in this, you are in a gain or loss frame. So you see that very small change, but with the different kind of framing, we would change the whole scenario of the results. That is directly relevant to pension communication. When market falls and members are sitting on paper losses, I would say that they tend to become more risk seeking, which I don't know to say if we are doing this at this moment, especially in the UK with the Middle East war or not. But anyway, in that situation, people tend to become more risk seeking, not loss, or not going for a loss. That is the opposite of what I would say before, what I talked with you, life cycle path was designed. This is a kind of asymmetry, and understanding this kind of asymmetry is really important if you want to design this kind of products. But anyway, we don't want you to design anything. We just want you to understand these questions if you try to answer to these questions and see. You might ask questions if you see these kind of questions that they are the same, but they are not really the same. They have different kind of framing. Another questions, I will bring everything at the end. Another question is 14 and 14 prime. This is a small stake version. So the previous one was the bigger one. The question 14 and 14 prime is the same pattern, but in kind of miniature. People here prefer the lottery ticket on some small games. They don't want a big house. They don't want Ome's lottery. They prefer the sure, very definite. They want to make sure that what they gain is small. This means that whatever they might lose is small. So this is kind of it's a loss over any kind of uncertainty if we are talking about uncertainty. So if you put all the 15 questions paired together, and you will get what we call a total risk style score, which this score would be for each respond. Plus, we have, as I said one slide ago, we have separate gain and loss scores. So we have three kind of scores. The total score will place each person on I would say, a spectrum from high risk averse at one end to high risk seeking and the other end. So you can imagine how we are going to work with this data. So we now have these scores totally, if I'm right, you tell me, Aaron, 650 people across 4 countries. Yeah? Yes. And these scores, they show how different people are, different lifestyle, different models will create different results. And believe me, the results for China is a huge difference between results from China than India. Then we hope that we have the different results in UK. This is the central point of the whole presentation, I would say. This is where the Kahneman-Stravinsky value function, we call this S-shaped curve, actually. It's not as S as it is, but it is like S. This represents the average pattern. So this steeper below zero than the above, which captures loss aversion. And I would say that the industry has been designing this kind of products to calibrate what is the average. But again, when we talk about the average, there are many factors that can change this average. This average kind of describing almost, saying that almost is nobody they are precisely correct. Two people, I would say, at the same age, same gender, work at the same country, same company, same industry, they can sit at completely opposite end of the risk spectrum that I explained to you a second ago. So one might be deeply loss averse, and the other might be comfortably with significant downside volatility. So again, it's all about behavioral finance. What I would behave financially would have an impact on where I'm putting my assets. Was it any question? No. Okay. Uh, what are we arguing in the whole scenario here is not the lifestyle fund that I explained for you. I would say lifestyle fund would be the wrong principle if we wanted to discuss. It is that the age alone, I would say, is a really good example to say that um, an individual who's extremely weak uh, cannot change this curve, and it's not about just the age. I'm just saying that there are different kind of factors that could have an impact on the curve and how it can be closer to risk averse or on the other side. And if you use a wrong variable to segment your members, whoever they are, you might put a lot of people on a very unsuitable default, unsuitable fragile default. So we hope that we with getting these answers from you guys and from the others, from the UK population, we can find a best suitable way or suitable defaults so that we can introduce it to the policymakers for our own sake, for my future and for your far, far future from now, hopefully, not now. Okay, these are the four plots that they came from. Is it Aaron's or is it Sid's paper? One of you guys' paper, and also Berlick 2017 paper that they showed what mean about individual variation. As you see, top left is about a female adult, loss averse, risk seeking on gain. It's a classical KT pattern, we would say. Top right is a male investment professional. He is a risk averse on both sides, as you see. He actually behaves more like a pre-KT rational agent than the KT model predicts. Bottom left here, we have a female college student. She's a young girl. She is a loss averse and risk averse on gain, which is super interesting. You don't see that someone can be loss averse and risk averse at the same time, but she is. Quiet, conservative, I think I would say she is, in my opinion. And we have here this guy. He's a male teenager. I think he's a young guy who wants to invest to buy some cars, maybe. He's a risk averse on losses, but risk seeking when it comes to gain. It's a different profile. These are different profiles, and we are showing this to you to just letting you know how we interpret multiple data that we checked before. Sorry, I'm just talking so fast because I don't want to miss any minutes. This is the cross-cultural findings that we think is most striking for the pension audiences. This is what we found. There are 4 quadrant presents for the 4 possible combination of a risk preference on a gain and loss, and they map on geographies in ways that are most completely inverted across different kind of areas, regions. Asian investors or Asia cluster was more on risk seeking on both sides. North American and European investors they are risk averse on gains, but risk seeking on the loss. Australian and New Zealand are both actually are like Europeans, and this is important for us today because, for example, South America, South America, UK, MENA countries, they are risk averse on both gain and both loss. What that means is that the products that is designed and optimized for North American investors, which we assume that they are risk seeking on loss and risk aversion on gains, they are actively working against someone like someone who's in the UK or South America who has an opposite profile. So this is very interesting. We might see this inter-country investors that are working together, but each one of them has their own profile risk-wise. Financial products, eventually they cannot simply be exported as we think they would be. I want to briefly take you through India study, which is my favorite country in the world. This is what we call Bharat tool. It's Indian specific adaptation of our questionnaire. The same 15 question pair is translated into culturally relevant Indian scenarios. Diwali Mela raffle, cricket decisions, 3-card poker. They are all the things that we did to remove the numeracy biases of the original KT survey that we had before. The original KT question was heavily favor people who are much more comfortable with abstract probability calculations. We don't have it for the UK. It's the same approach. We had 172 responses across a very diverse sample. It was about age, gender, education, occupation, religion, geography, primary asset holding. And what we found challenged almost every assumption we had about life cycle model, which we wouldn't assume it was like that. This is what we found. The original KT aggregate score was minus 4.10. The India aggregate was minus 11.77. Moderately, this showed that they were on risk seeking. And this, we are talking about India. It's enormous map. It's enormous population. Only, this is the interesting one, only 29% of Indian majority respond aligned with the original KT findings that we had, meaning 71% of Indian respondents behave in a way that the KT model didn't even predict about this. This, I would say, it was the implication of a pension design that showed the life cycle fund calibration. And actually, when we applied it on Indian savers, the design showed that the population really did not exist in Indian setting, let's say. Okay, now I'm going to talk about UK. This slide, before I do, this talks about Indian findings in myth versus reality format. What we think is the comparison of these two. And then we are now applying this in the UK. The age, the assumption for the primary driver turns out to have no statistical significance whatsoever for India. and not that 5%, not that 10%, not that 15%, flat line. All it was across all of the cohorts. About the education and occupation, as you see, the assumption to matter through the life stage and proximity to retirement lens. Actually, this was matter, but not the way that the model assumed it would be. I would say that diploma holders, they are highly averse on gains. Homemakers, they are most risk-seeking group that we had overall of this population. About gender and geography, the assumption was neutral, not significant at all. About religion, assumed to be irrelevant. As Aaron said, we deducted all of these for our models. And now let's see the UK one, which we are waiting for. So this is the result that we have right now. Until now, we have about 20, more than 25 responded for the new UK specific survey. As you can see, for these charts, the example is skewed. We are heavily on 50s and 60s. We want more teenagers or more younger people in their 20s, which is precisely the generation that we think that most affected by DC pension defaults. We are at this moment 61% male, and we are 71% postgraduate educations, and we didn't have any response from Muslims, and nearly half of the sample putting other or prefer no say about religion. So that's where the religion came from. I'm not actually going to pretend that 45 is statically robust, because we still need many more. But we do have a 211 validated UK responses from the earlier global survey that we had, which gave us a really robust foundation to work on this. And so we hope we get at least 150 or 200 at this moment. This is a genuinely good results at this moment, but we need your help, I would say. And this is, we actually have two results to show, which I'm going to explain to you by numbers. The numbers on the left, and I'm sorry, this should be white, but I forgot to make this white, so this is black. I'm sorry. This is 9.93. This is from the blended sample of 72 responded that we have. So Aaron combined 27 responded from our earlier global quiz, which is the same question order, with the 45 responded that we have from the UK. This is the most reliable estimation until now. Then we have this number. As you see, this is minus 12.67, which is from a 45 UK responded alone itself. More negative, meaning that more risk-seeking, smaller sample that we have. So we treat them as a little, and we need to be very cautious about them. So I'm sorry, either way, both numbers, it's all about the UK responded, and they are moderately risk-seeking category at this moment. Compared to the KT benchmark, which we talked, it was minus 4.10. This is moderately risk averse. So UK responded in our blended sample, they are more than, I would say, twice as risk-seeking as people in 1979 Western. And of course, this is not a really good compare, but it's a compare. I also do want to acknowledge that the sample size is still very small. Again, we need your help, and we need anyone's help. They can help us on this. The almost last slides. This is just a comparison, I would say, between KT 1979, which was minus 10. Then this is for the United Kingdom, China, and India. And you see how diverse the numbers that we have. We think this is really important for anyone in this meeting who works in a pension default, because I would say that the KT findings is not a law of the nature, and we need to change this. This was a measurement one day, but it cannot be implemented at this moment. That's what we really want to do for our research. What this means that in practice, any default fund that is calibrated to the assumption that savers are moderately risk averse is likely to be too conservative for the people they are actually serving. Sorry. And I'm almost done. One more slide, I promise you. This is where I'm going to walk you through the data that actually we showed that's driving the risk preference in the UK. What we have on the left is the significant findings that we had. The most striking results, as I said, was the politics. It was from a subset of 27 responded in the blended file who answered the political learning questions. Conservatives, the score was minus 0.96, almost exactly at zero, almost risk neutral, which is interestingly surprising. Liberals, they scored minus 9.37. They are strongly risk seeking. The difference here is statistically significant on a p-value of 0.001. That is very strong signal for the sample that we have. We need to be very careful here because we are not suggesting, again, that the pension product should be alongside any political lines, but this is something that we see, and we need to, of course, dig in more about that. About the education also shows a very significant difference, but specifically on a loss score, not on gain. I would say that high school educated responded where they're more measurably more loss seeking than more of the bachelor and masters. I'm sorry, guys. I need to sip of water. I can't talk like this.
Have a break. No, I mean, you're doing excellent.
Oh no, it's only the last slide. I promise you.
Fine. You're gonna get there. The finishing line is in sight.
I'm sorry. This is me teaching. Yesterday I had teaching for many hours, and then today I have this. I'm sorry. On the right side, what you see is what does not matter. It's a gender show, which is a no significant differences, and neither male or female respondents stand out on a total gain or loss with regards to gender. The honest summary, I think, for this slide would be that it's very early for us to come to assumption. But at this point, political findings especially is stronger enough that we think it deserves a proper conversation and discussion. And we have right now a clear picture, but we need more data to get a confident regression results and see what these factors could have an impact on risk when it comes to any financial decision. It's just that the last thing is that we want to flag the politic findings as an open question. So if anyone wants to discuss this, either private or in public, I mean, we have a wonderful post that I think Steve or someone else put on LinkedIn. You can write down under that. We can have a discussion. Please follow us on LinkedIn so we could be in connection, so you see what we are doing in future. I want to thank you for anyone who joined today, and thank you very much for listening to me. And this is the link, and I'm sorry again, this is black. Thank you very much.
No, I mean, that's fantastic. Lots of clapping. Lots of clapping, virtual clapping. Just got you over the to the end, which is excellent. The slideshow, hopefully, can we see a copy of the slideshow, Aaron or Namin? Is that okay? Okay, we'll get a copy of the slide. If anybody wants a slideshow, then please come back to me or Henry, and we can get that sorted. Obviously, data is key to the ongoing survey. So if you can share it with any of your friends, family, especially youngsters, That would be great. And as Billy says, it's a fantastic survey, and he enjoyed it immensely. So that's really, really good. I think obviously the other thing, of course, is JQ made the comment that there are nuances in the UK, Aaron, and you know these, which is I think people think differently in accumulation to decumulation. So there could be an argument to split this a little bit as well, and another session maybe later in the year to look at some more results on accumulation versus decumulation.